Good morning, dear students. Now, welcome back to your business studies class. Yesterday, we have started the business service banking part where you have seen that what is the main function of banks. So, commercial banks, you have seen that the main function is lending money and accepting deposits. Means they accept deposits from the public and they lend money to the public who wants the money. And in the meantime, they earn their interest. We have also seen the various types of bank, the cooperative bank, the specialized bank, the central bank, that is our RBI. Then we have also covered all the primary and the secondary functions of the banks. So we have done with the banking part completely. Now today we do the second type of business service, which is insurance. So let's see what this insurance is. So see, contract in writing whereby one party called the insurer agrees in consideration of either a single or a periodical payment called the premium to the indemnify another party called the insured against any loss or damage resulting on the happening of a specified event or events is called contract. Simply means, see, in insurance what happened, there is a contract in writing, means you have to enter a contract where you will write that one party who is getting the insurance, that is known as insurer, he is agreeing that okay, whatever is the terms and conditions of the particular party which is the insured, and then he agrees that he will give you a monthly or periodical, it's not always monthly, the periodical payment. That periodical payment could be monthly, it could be half yearly, it could be yearly, and that payment is known as premium. If you insure yourself, if you insure your car, you have to pay premiums. So you are promising them, you are entering into a contract whereby you are agreeing that okay, you will pay that premium to the indemnify another party, means that insured who is getting you the insurance. And for what? For the loss or damage for a particular event which you are specifying. Say for example, you are entering a life insurance. So if you die, that event happens or event is occurring, then you will get that amount. Say for example, if you are taking a fire insurance, so if that fire happens, you are supposed to get the money from that insurance company. So this contract is only known as insurance, wherein you are entering, there are two parties. One is the insurer who is getting insured, and the other part is the insured who is doing the insurance. And both of them are getting benefit because the insurer is getting the amount when the event is happening, and in return the insured is getting the premium which he is paying. And if that happening doesn't happen, all the money goes in the hands of the company. So if that loss of life or the loss of fire doesn't happen, then the whole premium money that so many years you pay goes in the hands of the company. So this is what is your insurance. Understood? Now see, if you look at a glance, you will see these words connected with insurance. Please jot down this in your copy. When you talk about insurance, the first important thing is you should have a contract. Without a contract, insurance is never made. Understood? Then there should be one party who is getting insured, that is known as insurer. And there should be another party who is doing the insurance, that means insured. Then you should be paying some installments, some money, which is known as your premium money. Then there is some period of indemnity, means the period for which you are taking. For which event are you taking? LIC you are taking, loss due to fire you are taking, loss due to theft you are taking. So for which thing? Car insurance you are taking. So indemnity is for what you are taking and for how many period you are taking. Subject matter, again you will have to give detailed information about everything. Suppose you are doing a stock of your doing an insurance of your factory. So you have to give every detail about your factory, how much of stocks remain in your factory at a time, how many people are working over there. Everything has to be given to the company because they will charge the premium according to the amount of things that is there in your factory every day. If you have goods worth rupees 1 lakh rupees in your factory, so obviously they will set your premium accordingly. If you have goods of rupees only 50,000 at a time, then they will charge you premium according to that. So subject matter has to be disclosed. And last, you should have a policy wherein you both are agreeing, both the parties are agreeing that they are going to, one will give the premium and the other will cover the loss if the event happens. So this is an insurance at a glance. Understood? Now let's go towards the functions of insurance. So what are the functions of insurance? Let's see. See the first function, providing certainty, means insurance provides certainty of payment when the loss occurs. If you are getting insured yourself, then certainly you will get that payment when that loss occurs. Guarantee is there. Suppose you die, and you have taken an LIC policy, so your death will give your family that amount. Suppose you have taken a loss by fire. So if that fire occurs in your godown or anywhere, you are surely supposed to get that amount. So this is a certainty kind of thing. So this is a very important function of insurance, that certainly you will get the money. There is, when the loss occurs, you will definitely get the money. Understood? Second point is protection. Now, insurance creates a sense of security to the insured. You are getting a sort of security. Okay, I am protected. There is a chhatra chaya for me. There is a protection under which I am there. I am just paying a premium, but then my life is covered, or my stock is covered, or my factory is covered. So you get a sort of protection, a protect from that happening. Understood? Risk sharing. Obviously, you share the risk. The risk of loss can be shared among all the policyholders. Suppose company and you, so both of, if you are doing insurance but to only a certain limit, so obviously half of the risk is in your hand and half the risk is in the hands of the company. So a sort of risk sharing is there. You don't have to bear the total loss. Some loss will be given by the company. So a sort of risk sharing is there. Understood? And the last function is assist in capital formation. Means the fund collected by the way of premium can be invested in various income generating schemes, thus result in capital formation. This is from the company's point of view. Now company get to have lot of capital. They collect the fund in the form of premium from various users, and as a result, lot of income can be generated, which they can invest in some proper scheme, so that they will have lot of money. They will earn from there, and then only they will return the insurer people who are getting insured. Say for example, hundreds of people, common men are there who are doing LIC. So when they do the LIC, the premiums are going in the hands of the company. Now when suppose this company will do what with so much of premium? Every year not the people are dying. So a lot of premium is coming in their hand. They keep investing in some projects so that they can generate income. And say for example, when any time they need money, say for example a person dies, then they will have a lot of money to pay them back. So this happens. This is the sort of capital formations for them. They are getting help in forming the capital. Understood? So these were your functions of insurance. Now let's move towards the principles of insurance. So let's see what are the various principles of our insurance. So the first principle is principle of utmost good faith. Means while entering a contract of insurance, you have to disclose all the material fact. Otherwise it will become void. Void means it will be invalid. See, you cannot hide anything. Say for example, if you are going for an LIC policy and you already have a cancer, then you will have to pre-hand tell that insurance company that you are already a person who are having cancer, because you may die in 2 years also, suppose. So then the company will not pay you. So you should have to inform earlier that whatever is the problem. Otherwise the contract will automatically be void if you hide things from them. So while entering into a contract, you have to give each and every material fact properly to the company. This is the principle of utmost faith. Means they are ultimately having good faith on each other when you enter into a contract. Nothing is hidden between the company and the holder. Okay. Number 2, insurable interest. Now the insurer must have an interest on the subject matter of insurance. Otherwise the contract of the insurance become void. Now if you don't have any interest in that matter, why are you signing that contract? So a person who has advanced money on the security of a house has an insurable interest on that house. Suppose you have insured your house, but that house is not yours, or you have taken a bank loan and you have done that. You have a loan and then you have taken a insurance policy. So you must be having that interest in the house. Now ultimately that house is yours. So you would want that your house is being protected. Now if someone doesn't have an interest in that house, but still he has just entered into a contract purposely just to, make a contract, then he may destroy his own house just to take the claim. So that thing should not be done. So it is a principle of insurable interest. Means if you are doing insurance for that particular thing, you must have an interest in that thing. If you are doing insurance for your house, you must have an interest in that house. Otherwise it is an invalid contract. Understood? Moving to the third point, indemnity. Means if the all insurance except life insurance and personal accident insurance are based on the principle of indemnity. Just leave about the life insurance or personal accident. Otherwise, everything is under the policy or principle of indemnity. It means what? Insurer is entitled to get only the actual amount of loss suffered by him, and it will not be a source of income. It's not that he can see that this is my source of income. He will get only that amount for which he has done the insurance. Like I told you, suppose in your factory you have goods worth rupees 1 lakh. But then you are doing an insurance only for 50,000 rupees. You're cheating, because you know that for 1 lakh rupees stock, your premium amount will be more. And when you show that I have 50,000 goods, then your premium money will be low. So if you cheat, then you will not have to, if you want to save your actual amount. So obviously they will also give you protection up to 50,000 rupees goods only, not more than that. But in LIC and personal accident, the whole amount you get. If by accidentally you die, if accidentally there is anything done, the whole amount goes in the hands of the family members. But otherwise, in all the other different types of insurance, you will get only the amount for which you have insured yourself. You can't treat it as a source of income for you, that okay, I have done a policy of 50,000, but I will give 10 lakh rupees. No. So indemnity means up to the amount which you have done and up to the period you have done. So this is the third principle of insurance. Understood? Fourth is causa proxima or proximate cause. It means nearest cause will be considered for compensation. It means that insured can cover the loss only when it is caused by any of the risk insured against. If you are having a risk of loss, a risk of fire, or a risk of theft, so if you have covered your policy for loss by fire or loss by theft, so you will be getting the compensation only when actually fire occurs or only when actually the theft occurs. If you are doing a fire insurance and theft is occurring, you will not get the money back, because you have taken insurance for fire and fire has not occurred in your factory. Theft has occurred. So for theft, you will not get back the insurance money. Understanding? So you have to get for only the risk that you have covered. Proximate cause, you have to mention the cause. Fire is my cause, so for fire only you will get. Theft is your cause, so for theft only you will get. Understanding? This is causa proxima. The next one is subrogation. It means after the payment of loss, the whole right of the property is entitled with the insurance. Means if the loss payment is done, now the whole right goes to the person who has done the insurance. The insured should not make any profit by selling the damaged property. Say for example, I have covered my car and my car got destroyed. Now the insured will give me the money. The company will pay me the money for car. Now after taking that payment, the car is also mine. Now I can sell that car in a scrap value to any bhangad wala and he will give me the money. It's not that the company will take up the car because they have given me the amount. Car is also mine and that coverage is also mine. I'll get the money from the company. Plus the car is also mine. I have a right to sell that car, that damaged property. It's not that the company will take away. So this is subrogation. This is that principle that the property also remains in the hand of the insurer who is doing the insurance, who is taking the policy, the holder. Understood? Moving to the sixth point, contribution. When the same subject matter is insured with different insurers, the actual amount of loss is divided among various insurers. Say for example, one insurer, suppose you are taking a liability, you are one insurer. So your amount will be sum insured with that insurer divided by the total sum insured. Means if you have taken one insurance with lot of company, LIC you have taken but with two companies. So obviously it will be divided. You will have to pay the premium also accordingly to both the companies and the coverage will also be divided among the two companies. So it is a matter where you cannot cheat and take policies with 2 or 3 companies. You have to divide your amount also of premium with 2 companies and the money that you will get back from that company will also be divided in both the companies. So this is contribution. And the last principle that you have is mitigation of loss. Means it is a duty of the insured to take preventive measures to minimize the loss of the property. Means you have to try to have minimized loss for the property. Say for example, you have taken a fire insurance for your house and you have seen a fire occurring, but you will not do anything. Janle do, I'll get the money from the company. No, you should try to control that, minimize the loss as much as possible. So if any expenses are occurred by him for such activity, it is entitled to get that much of amount along with the compensation from the company. Means if you have suppose called a fire brigade services and you have given them 10,000 rupees and you have tried to protect the house, so that 10,000 can also be claimed from the company because you tried to reduce the loss, minimize the loss. So you can also ask for that compensation from the insurance company and the insurance company will pay you. So you should be trying to save as much as you can. This is mitigation of loss, trying to reduce the amount of loss. These are your 7 principles of insurance which are all very important. It's also in your book. So please write down everything in your notebooks and learn all the principles properly. You may not get like explain all the 7 principles. You may get just like explain the principle of mitigation of loss, or explain the principle of policy of utmost good faith. So anything of that sort could also come. So please learn all the principles very nicely. Understood? Now let's move to the types of insurance. Now there are various types of insurance. Today we will cover only one type, which is our life insurance. And there are many more, so we will do it in the next day. See, types of insurance means one is life and one is general. So today we cover only life insurance. General has again 3 subparts: fire, marine and other insurance. You can go for fire insurance, you can go for marine insurance. Marine is related to water, and other insurance also. We will cover these parts tomorrow. So today we move to life insurance. See now what life insurance is. A person can take a life policy on his own life or on the life of another person. Means you can take a policy for yourself or for your spouse or for your children. Anyone else, you can also take that policy. Husband on the life of his wife can take, on children he can take, so anything. So this is a policy taken for one's own life. So this is what is life insurance. Understood? The person who insures his life is called the assured. Means suppose you are you're taking the policy for yourself, so you are known as assured. Please remember. Here a specified amount of money is payable on the duty of the insured or the expiry of the specified amount. Means on the demand, if you will have to demand that how much you want. So you have to take a policy of 10 lakh or you want to take a policy of 20 lakh. So you will demand that, and on the expiry of that period you will get back the money. So a specified amount is payable only on the demand of the insured. Means you are demanding. Suppose you died and your family is demanding. So either on the demand or on the expiry of the period. Suppose you took a life insurance for 20 years and after 20 years you did not die. So you will get back the whole money. So this is what is your life insurance. Understood? Now see the types of insurance. LIC enjoyed monopoly of life insurance business till the end of 2000. Means till 2000 there was only one company, Life Insurance Corporation. See the logo, Life Insurance Corporation was one company, insurance company, who was enjoying the monopoly right of doing the LICs. But now we have a lot of private insurance company. For example, Bajaj Alliance, Max Life Insurance, HDFC Life Insurance, Birla Sun Life Insurance, Tata AIG Insurance. So earlier it was only the monopoly business of LIC, but now you have a lot of companies entered into this type of business. Understood what LIC is? Now let's move towards element of life insurance. That means what are the things in these life insurance? So what are the factors? First is you should have a valid contract. It means life insurance contract must fulfill all the essential conditions of a valid contract. You should have a proper valid contract entered between insurer and the insured. Both of you should have a proper valid contract. Only verbally will not do. Everything has to be written and all the terms and conditions has to be written. Understood? Second, utmost good faith. Again, the insurance and the insured must disclose all and each and every material fact. As I told you, suppose you are having cancer, you have to detailedly explain that you already have cancer, or you already are diabetic, or you already have some problem. So everything has to be given in detail. All material fact has to be shown. You cannot hide things over here. Okay? Third is insurable interest. Again, the insured must have an insurable interest in the life of the assured at the time of taking policy. It is not needed at the time of maturity. It's not that you are only doing the insurance so that you will kill that person and take back the money. You would be loving that person for whom you are doing the insurance. You would want that person to stay alive. You're not ultimately doing the insurance just to kill him and get that money. It's not only you're waiting for the maturity period. Okay, so you should have an insurable interest for that person. Fine. And the last element that you have is not a contract of indemnity. I told you LIC is not a contract of indemnity. Means the life of a human being cannot be compensated in terms of money. Obviously, you cannot compensate anyone's life for money. So that the amount payable to the insured only at the happening of the event is fixed beforehand. Before only you determine for how much lakh of rupees you want to take the insurance. 10 lakh, 20 lakh. So it's not that you will calculate at the end. Ki, okay, the person died within 5 years. So 5 years maybe you only got this much of premium. So aapka hisab itna hi hota hai. No. Life cannot be compensated in terms of money. So if you have entered a contract for 50 lakh, for 50 lakh rupees you are paying the premium, marne ke baad you will get the whole 50 lakh. Same if you are doing an insurance only of 10 lakh, so you will get that 10 lakh. No bargaining system is over here, or no calculation that kitna ka stock tha. But in other things, in fire insurance, they will check how much of stock was there in your godown. So here there is no point of indemnity. Please remember these elements of life insurance. Understood? Now we move towards types of life insurance policies. That what are the different types of life insurance policies? This is our last point for today. So the first one is whole life policy. Means this policy taken for one's whole life, and the payment will be made to the legal heirs. Means if you die, the whole amount will go to your family members. So even if the premium is payable for a fixed period, say for example 20 years or 15 years, the policy will continue till the death of the person. Means you have to continue till the death. Even if the period is fixed 15 or 20, you will pay the premium for 50 or 20 years, but the policy will continue till the death of the person. So this is for your whole life. When you die, then only you will get the money from your family members will get the money. This is for your whole life. So that's why the name is whole life policy. The second one is endowment policy. This policy is taken for a specific period. You are taking a policy for a particular period, 15 year or 20 year. An insurance company will undertake to pay a fixed sum when the insured attains a particular age on his death, whichever is earlier. Either you are taking, suppose you are taking for 50 years, so 15 years, so you have attained an age of 65, after which you cannot pay the premium money. So either the age is attained for which you have taken, or suppose the death has occurred earlier. So whichever is earlier, you will get that policy, you will get that payment. So if your age has come first or death has come first, so you will get the policy whichever has come earlier. But in the whole life, you will get only when you die. Your heirs will get that amount. But endowment, you will get that amount. Understood? Third one is joint life policy. It is a policy taken out jointly for two or more persons. And premium can be paid jointly or any of them in a lump sum. You can, suppose me and my husband do, both of us have a joint life policy. So this policy matters either on the death of any one of the assured or either the expiry of the. Suppose I die, then my husband will get the whole claim. Or say our period for which we have taken the amount policy has expired. So then we will get the amount. But ultimately it is for both of our lives. So it is a joint life policy. Understood? Annuity policy, the fourth one. In this policy, the assured gets a regular payment after he attains a particular age. Means pension type of plan. You have attained an age of 65, after which you will every year get or every month you will get a particular amount which you have set. So this premium is paid either in installment or for a definite period. You can pay in installment or in single premium up to your wish. You take such policy and after retirement you sit and get back the money monthly or say yearly or say half yearly as per your policy. So this is fourth one, annuity policy. And the last one that you have is children's endowment policy. Means this policy is taken by a person to provide funds for the education or marriage of his or her own children. Suppose I want to take a policy for my son's marriage or for my son's education. So if the parent dies before the maturity, the policy will continue to exist even without the payment of premium. Suppose I die and my son hasn't got married. So the policy will continue up to when he gets married, and during his marriage he will get that money. I don't have to pay any premium, but my children will get that facility from the company. So this is your children's endowment policy. So these were your 5 types of LICs. Now please go through all these points and jot down the things in your notebooks. Tomorrow we will cover the second part, which is general insurance. Okay. Thank you. Have a nice day ahead.